We're told that $8 trillion has been wiped off global share values. Well, let's take a look at some of the major developments in the markets and how it will affect people. In the US, the Dow Jones has lost about 1,000 points in the last 5 days of trading. That's almost 10% of its value. And here in the UK, the FTSE has lost more than 770 points over the same period. That's about 13%. Markets are taking a more pessimistic view of future economic growth, with recent turbulence caused by the sovereign debt crisis in the Eurozone and the loss of America's AAA credit rating. The banks own much of Europe's sovereign debt, and with a rating drop, US banks face the prospect of higher funding costs. Yes, you've guessed it, that can have an impact on the credit supply to customers, whether they're companies or individuals with loans and mortgages. The European Central Bank, meanwhile, has been criticised by some economists for raising interest rates too early in an attempt to stem inflation. The move in part forced the ECB to buy up Spanish and Italian bonds to prevent Europe's debt crisis from deepening. But regardless, the economic turmoil has had an effect on pensions. In Britain alone, more than $195 billion has been wiped off their value in the last month. But we don't need to worry too much about short-term fluctuations, however dramatic they may seem, since pension planners tend to move funds into lower-risk assets as retirement approaches. It is the longer-term trend and overall returns which are important. We've seen some of the biggest equity market falls since the credit crunch in 2008, but company results are looking much healthier than back then, and many analysts are asking whether we've seen the worst of this crisis. But one thing is for sure, when markets do recover, we won't be reading headlines about trillions of dollars being put back onto share values.